We're going to hold questions till the end. I just want to call your attention on the back wall to the letter to Congress and the petition which the Carbon Tax Center has put together. Our next speaker is Dr. Gilbert Metcalf, who is professor of economics at Tufts University. He's been chair of the department there. He's taught at Princeton, at MIT, at the Kennedy School, at Harvard. He's a specialist in public finance and issues of taxation. He has also consulted to the Department of Treasury and the Chinese Ministry of Finance. We look forward to your remarks.
Well, it's a pleasure to be here, and it's a pleasure to see the large turnout for this event. So let me just start with some comments on why we want a carbon price at all. And the simple answer is it is a cost-effective way to achieve environmental goals. If we look at the experience of the tradable permits under the acid rain program, it's estimated that it reduced the cost of cutting SO2 emissions in half from doing that. It's also an alternative to cumbersome and potentially contentious regulatory instruments. One of the concerns I have with the discussions going on now about the possibility of an endangerment finding for carbon dioxide under the Clean Air Act is that this could actually impede our efforts to reduce carbon emissions by tangling things up in regulatory and legal delays. It's simply much cleaner to go with a pricing approach. So given that I think all economists can agree that it's more efficient, cost-effective to take a pricing approach, a market-based approach, why a carbon tax? And so let me run through a few reasons. Congressman Larson there's be a fair amount of repetition today because I think we'll find there's a lot of agreement on the issues here. One issue I think that's quite important is the transparency of revenue under a carbon tax. I think it's important to as the congressman said, it's important to be transparent, to include the revenue in the budget process. With grandfathered permits under or freely allocated permits under a cap and trade system, we obscure the transfers of monies that are going on, and in fact we take it out of the budgetary committees in a sense by leaving the allocation of permits to other permits. So it's a hidden transfer. Congressional Budget Office last November I think made a very good decision in their budget scorekeeping, in their scoring rules, that they would treat freely allocated permits as both revenue and spending to really drive home the point that there is this transfer going on that's not so clear with freely allocated permits. Allocation, we're creating very valuable assets with permits. And I think one thing that we found in the discussion of the previous cap and trade bills is that we're really focusing, the allocation has been focused on compensating the wrong parties. We're talking about compensating the regulated sectors when we really should be compensating the affected parties. And I think that's much clearer we'll see that's clear in the carbon tax swap that I'll discuss in just a moment. As we've already heard, the administration is much more straightforward with a carbon tax. All of the fuels that are responsible for 80% of greenhouse gas emissions in the United States are currently being taxed. It would be very easy to initiate a carbon tax. CBO last year released a study that talked about the considerable lead time needed to establish allocations. We've already heard about RGGI today. Efficiency, with a cap and trade system, we are fixing the amount of emissions, letting the price fluctuate. With a tax, we're fixing the price and letting the amount fluctuate. And economic modeling has consistently shown that a tax is more efficient for given expected greenhouse gas emissions, given abatement cost uncertainty. And there's tremendous abatement cost uncertainty. We have no idea whether carbon capture and storage will work at scale and what it will cost. We have no idea what new battery technologies will come online. So there's tremendous uncertainty there. And even if you allow for banking and borrowing, it's still the case that a tax is going to be more efficient, less costly. Price volatility is a major concern. We've already heard that businesses want to know the prices they face. If you're talking about making a very expensive capital investment that's going to last 50 years, you'd kind of like to know what the return on that investment is going to be, or at least have some sense. And that's where the price certainty, I think, is really quite important. You don't need the complicated schemes like the Carbon Market Efficiency Board. You don't need a safety valve, which if it's binding, is just a tax. So, in a sense, why go to the second best when you can have the first best? Now, with their concerns with cap and trade about upside price risk, there's also concerns with downside price risk, because the only way we're going to solve this problem is through technology. And the technology is going to be driven by high carbon prices. If we have low prices, we won't get the induced innovation we need to crack this problem. So again, price certainty is quite important. And lastly, on the international front, there are really important issues with thinking about trade. Now, certainly importing fuel, we do that, and it's certainly easy to think about taxing the carbon in embedded fuels, or even requiring permits for embedded fuels. The harder problem is the embedded carbon in the steel we import, in the cement we import, the aluminum, all that stuff. And there are really two issues. The first is if we compare a cap and trade system with a tax system, which is going to have a greater likelihood of being made compatible with the WTO? And I think there, the experience we have experience with border tax adjustments, with value-added taxes. I think it is likely to be the case that we will have an easier time making a tax compatible with the WTO. With the embedded carbon in imported products, this is a tougher problem, but I think this is not insurmountable. David Weisbach at the University of Chicago and I have a paper on this. Here I think the issue is we should focus on a few goods with substantial carbon content, 5 or 6 goods, aluminum, steel, cement, a few others. And we don't need to know how much carbon is actually in them based on the production processes in China or Indonesia or wherever. We can use the U.S. equivalent, the U.S. Embedded content. This levels the playing field between imports and domestic products, and you can allow for an opt-in feature if a country can come in and prove that it actually has lower carbon content in a ton of steel than the U.S. So I think this is a much easier way to go, and I think it could be made compatible with the WTO. And we would, in the jargon of international tax, we would do a combination origin-destination system. Jim Hansen sort of said it eloquently. If a country like China has its own carbon price in effect, then we don't collect the tax at the border. But if they don't, then we do collect the tax. And, of course, that provides the incentive for countries to develop their own carbon price so they can keep the revenue in country. So how do we design a carbon tax? The issues, the key issues are the tax base, the rate, and then what do we do with the revenue? I did a paper for the Hamilton project at Brookings, as well as some work for Brookings and World Resources Institute for a revenue-neutral carbon tax swap that Congressman Larson was kind enough to mention. The tax should be an upstream collection. We should tax it at the source where fossil fuels come out of the ground. Energy-related CO2 is about 80% of our greenhouse gas emissions. It's more difficult to get the remaining 20%, but David Weisbach and I estimate that we can get about half of that remaining 20%, half of the 20%. We can get to about 90% of greenhouse gas emissions in a system that's not too administratively burdensome. For natural gas, there are lots of gas wells in the United States, but only 530 processor plants, and that would be the place to do it. Virtually all natural gas goes through these processor plants. If you tax the processors and the 55 import points, the 5 or so LNG facilities and the pipelines, you can catch the natural gas. Coal, less than 1,500 operating coal mines. Not only do you capture you tax the embedded carbon in the coal that comes out of the ground, but you can also include coal bed methane which is also a potent greenhouse gas. We can capture that by taxing at the mine. And then petroleum, there are 149 refineries in the United States. That is a logical place to levy, to administer a carbon tax, as well as import points. The beauty of carbon dioxide is that there's very little in the way of process transformation that changes the amount of carbon that comes out of a ton of coal. We can capture and store it. That's a different issue. But its production processes don't really change the amount of carbon that's released. That gives you greater flexibility to choose where to levy the tax. So upstream is quite efficient. What's the tax rate? That certainly is I think an important issue of discussion. I'm not going to take a position particularly, but I just want to point out that you have some flexibility. What we care about is what are the cumulative emissions over the century? And let me just focus between now and 2050. If we want to achieve, say, a 50% reduction in cumulative emissions between 2012 and 2050, you may think that's too low or too high, but just for purposes of argument, I did some research with colleagues at the Joint Program on the Science and Policy of Global Change at MIT, where we look at the different tax paths that you can use. So one approach would be, say, a $15 tax. This is all real dollars in 2005 dollars. Growing 10% real per year on carbon dioxide only. That would get you a 50% reduction in cumulative emissions. You could have a slightly lower tax rate growing at the same rate if you could capture all greenhouse gas emissions. Technically, that's going to be difficult to do, but by broadening the base, it allows you to have a lower rate. Or you could start with a higher rate and grow at a lower growth rate over time. And what we've shown in our work is that you actually get some significant differences in the cumulative welfare costs of these policies. The cumulative welfare cost with the first policy is about 1.2% of change cost reduction in welfare, which is a combination of GDP and the value of leisure. But the cost can be as low as about 0.75% if we have a higher initial rate and grow more slowly over time. So there are really 2 points here. The first is that the tax path over time can affect the welfare costs significantly, and the second point is that the welfare costs are really not that large to begin with. This is compared to a business as usual path where we're doing nothing and welfare is growing over time because our economy is growing. So a carbon tax swap, my proposal has been to have a tax on emissions, have a refundable tax credit for any carbon that we sequester, if we can actually crack this nut of doing carbon capture and storage at scale. We have border tax adjustments for fossil fuels. We tax the embedded carbon on imported fuels. And we provide an environmental earned income tax credit that's equal to an initial amount of payroll tax. In effect, given 2003 emissions, if we did a $15 per ton tax, it would allow you to basically give back the first $560 of payroll taxes. I linked it to payroll taxes. I wanted to have some efficiency benefits from this because it does actually provide incentives for labor supply, for secondary labor supply primarily. But I'll talk a bit about the trade-offs between equity and efficiency in a moment. Upstream system with a capped environmental earned income tax credit, that achieves distributional neutrality. It's revenue neutral. And as we heard from the congressman, this I think is quite important on political grounds. We really don't want carbon policy to get caught up in the debate over the optimal size of government. So what is the distributional implications of a carbon tax? This bar chart here ranks households on the left from the poorest households to on the right the richest households. And what you see is that the axis is the vertical axis is the change in disposable income. So the poorest households facing a carbon tax would see a reduction in their disposable income on the order of about 3%, whereas the richest households would see a reduction of less than 1%. So this is a regressive tax. There's no getting around it. The carbon pricing is regressive. And this is true with a carbon tax or a cap-and-trade system with 100% auctioning of permits. However, with the tax credit, giving the revenue back in the way that I've described it, that is a progressive approach because a greater proportion of the money is going to poor households as a proportion of their income. So that putting it together, you get a system that is roughly distributionally neutral. So except for the lowest 20% of the population of households, it's effectively distributionally neutral. The issue in the bottom deciles is since we're giving this back linked to payroll, if you're not working, you don't get a credit. But we can modify the proposal, and so now at each income grouping, from the poorest on the left to richest on the right, I have sort of three proposals. The left bar, the one that starts out negative, is the one I just showed you, the environmental earned income tax credit. The middle bar expands the credit to the rebate to give a rebate to Social Security recipients. Everyone gets a slightly smaller rebate because we're spreading it over more people, but that actually doing that makes the carbon tax swap proposal, that makes it modestly progressive. And if you do what Jim Hansen was proposing, which is basically a lump sum rebate to every household of the revenue, you could do that too. That gives up all of the efficiency benefits, but it gets you even more progressivity. So you have this trade-off between getting some efficiency benefits in labor supply versus greater progressivity of the reform. The middle one gives you sort of a balance between the two. In contrast, if we do cap and trade, and if we do what we did under the SO2 trading program, if we do what the European Union did with the emission trading scheme, and we give away all the permits, this is distinctly regressive. Low-income households are made worse off. High-income households are made better off because the value of permits shows up in higher values of equity, which is primarily held by high-income households. There's some concern over regional distribution, so ignore the rebate for a moment. And this just shows distribution across regions of the country. And this takes into account different driving patterns, different source of fuels for electricity. And you find that there's really not a whole lot of difference in the regional burden, maybe as much as 0.4% of disposable income. This is not a tax that's going to disproportionately impact one part of the country over another on a consumption basis. So it will certainly impact the coal industry. Let there be no mistake, a carbon tax or a cap and trade system is a tax on coal. The annual payroll compensation to workers in the coal industry is on the order of $7 billion a year. So this is not an insurmountable problem to address the concerns of transition concerns of workers who are in the coal industry currently. And of course, much of our coal comes from the western part of the country, which in fact hires very few workers to mine that coal. It's all mechanized. So just to conclude, I think carbon tax has a number of advantages that we've heard this morning already. Cap and trade certainly dominates on political expediency grounds, but the public opinion is shifting, and Congressman Larson has already made an eloquent case for how the ground is shifting on that front. It is certainly the case that any form of carbon pricing is preferred to a regulatory approach, things like the endangerment approach that is under discussion now. And of course, a hybrid cap and trade with a safety valve blurs some of the distinctions. But it doesn't overcome the efficiency advantages of a carbon tax. Carbon taxes are regressive, but a carbon tax reform need not be regressive. We can design it to have whatever degree of progressivity you would like. And it is essentially distributionally neutral across regions. And finally, I'll just leave you with some readings. If you'd like to get into more detail on this, here are some things that get into these points in greater detail. Thank you very much.